Now, the other thing they passed, Congress did, was the Glass-Steagal Act. I think I have the spelling right. And that has to do with banking. The Glass-Steagal Act was passed in response to all these bank failures, and what it in essence said was that banks, it required banks to go back to their original purpose and to make loans and hold deposits and not to also be involved in separate investments. What they wanted to do, Glass-Steagal Act, it was force banks to have different organizations be involved in investment banking, taking risks, buying stocks, doing all that risky sort of stuff, and separate that from banks who held our money and made loans. There was no restriction like that leading up to World War II. Leading up to the Depression. And it led to a lot of problems, these failures that we talked about. So the Glass-Steagal Act was put into place in order to address that and to force banks to be much more narrowly focused on doing their main thing, which is taking deposits and making loans. What's really important is that this law, which was passed like in 1934 or something like that, do I know that date? Don't have it written down. So let's say 1934, roughly. This law that was passed in 1934 persisted all the way through into the late 1990s. It got amended a little bit along the way and changed as financial institutions changed and all, but its basic restrictions stayed in place until the 1990s, and then pretty systematically the banking lobby convinced Congress that this was a old, outdated thing that didn't properly mirror the financial system today, and that U.S. banks had all sorts of competitors all over the world who didn't have the same restriction and who could do investments and take deposits and make loans, and that in order for the U.S. financial community to be able to compete, they needed to have these restrictions removed. This was not just a Republican-Democratic thing. Actually, finally, the Glass-Steagal Act was, in essence, repealed during Bill Clinton's last term. The law itself was driven mostly by some Republicans, but nonetheless, Clinton signed it, and we were all feeling pretty good. That was, I think it was like 98 or 99 when the final repeal took place. The economy was going great guns. We were full of all sorts of optimism about the strength of our economy and the strength of our financial system, kind of like we felt in 1929. Really, it's very similar mirror sort of thing. We had the roaring 90s, if you wanted. Here, things had been going really well. We wanted to unleash these financial tigers and let them compete on the world scale. So let's get rid of that old Depression era sort of thing. And we shouldn't have done that. Shouldn't have done that as part. Let's also go to the gold standard question. We entered the Depression on the gold standard. So the U.S. government, by law, preserved the relationship between gold and the currency, agreed to change it, on a fixed value basis. Basically, all our currency was backed by gold in the vault someplace. The first thing that President Roosevelt had to do, I think within his first year in office, he broke that promise to one extent, and that's that he stopped, when Congress had to do this, but basically through his influence, the U.S. government stopped guaranteeing that they would exchange gold for money. They still were nominally on the gold standard. They still said it is still the policy of the United States that its currency is backed by gold, and that we'll try to manage the value of the currency to keep it on par with gold. but we're not going to actually let you come to a U.S. government office and turn in your currency for gold. They were afraid that too many people during this economic crisis would try to do that, that they'd be worried about the value of the currency and that they'd try to come in and exchange it for gold, and that would wipe out the gold reserves for the United States. So Roosevelt sort of took half of the, in a sense, half of the gold standard away pretty quickly. But then Congress and the Federal Reserve had a voice in this too. For several years, decided to try to stay to the gold standard, and what was remaining here in the gold standard was the idea of keeping the value of the dollar and the value of a certain amount of gold consistent, not letting the dollar sink in any kind of value against gold, but trying to keep them at some sort of set exchange level. And they were very afraid that if they removed that restriction, if they let the dollar just float on its own, that what it would do is that a lot of people would speculate and drive the value of the dollar down really badly and make it almost worthless on the international scene. That was the fear. Now, as it turns out, Ben Bernanke, the guy today who's the chairman of the Federal Reserve Board, he did all of his sort of, I think his PhD and certainly a lot of his academic work before coming into government service, based on the Depression, and in particular looking at what caused, not only what caused the Depression, but all the responses the government took to try to correct it. And he and some co-researchers have looked at it and found that there were other countries around the world that abandoned the gold standard sooner than the United States. Typically when they did that, it did mean that the value of their currency on the world market did drop. So that wasn't great. But on the plus side, if the value of your currency drops on the open market, then your goods become cheaper for other people to buy, other countries to buy. And what he found is that countries who abandoned the gold standard sooner got out of the Depression sooner. In other words, they were able to recover much more quickly by abandoning the gold standard. The United States was one of the last ones to abandon the standard. I think maybe Britain was the absolute last. But in any case, the United States was one of the last ones to abandon the gold standard, and so it actually caused the Depression to go longer. So we held on too long, which, it just made the Depression last longer as a result.